Hey there, Jeff with Epic Trust Investment Advisors, and it is Monday, March 9th, and today we are into a crazy day for Money Monday. This has been a wild down day. So what have we got for you today? First up, we're going to talk about the Saudi Arabia and Russian oil price war that started over the weekend, and frankly, that is driving the market down today so strongly. We're down almost 8% on the S&P 500 today. We're going to talk a little bit more about that. We're going to talk about our economic and technical indicators and what we're seeing right now, the coronavirus update and the stock market reaction to what's going on. President Trump is supposed to meet with economic advisors on Wednesday to decide what kind of stimulus they're going to add it to the marketplace and how they're going to help us there. And then finally, an update to the trading playbook. A week ago Friday, I gave you some insights on what we should be doing to help protect our portfolios and how to take advantage of the opportunity that's in front of us today. I'm going to give you 3 more things today. I'm going to tell you how to take advantage of this huge opportunity in front of us. So be sure to stay tuned to the end of the video because I'm going to share with you our next move to provide a portion of our accounts with a 20% downside buffer from where we are now and without giving up any upside potential that the stock market could produce for us over the next couple of years. So this is a big one and you won't want to miss it. So stay tuned. First up, Saudi Arabia and Russia started an oil price war over the weekend. What does that mean for you? Well, for right now, it means that the S&P 500 is down another several percentage points today. So far, year to date, it's down over 14.5%. And from our best day ever to today, back on February 19th, we're down over 19% from where we were on the 19th of February. Just to give you some reference points, the Dow Jones Industrial Average is down a little over 16% for the year, and the NASDAQ is down almost 11%. So the NASDAQ and tech stocks are actually doing just a little bit better than the rest of the economy for right now. So what are we seeing in the technical market indicators? Right now, we still have the same as we had last Monday. We have one, our weekly demand indicator is still sitting in a negative territory, and our quarterly trend indicator, which triggered last week, is also still showing negative. If that goes and stays negative for the rest of this quarter, which is going to be through the end of March, then this will turn to a red signal and be a further confirmed potential negative for the future of the market. But so far we haven't seen our monthly and yearly trend indicator start to turn yet, which this is the big one that we would see normally in or around a recession. We're not seeing that one or the next one going either, so that's good news for now. What else are we not seeing in the stock market, or at least in the economic environment? Well, right now, our economy is still in pretty good shape. There's a whole lot of uncertainty out there right now due to the coronavirus and what is happening there. But the reality is that once we get through what's going on with this coronavirus and demand returns for goods and services as well as oil, which is what started the price war here, and I'll talk about it again here in a minute. But as we get through and get our hands around what's going on with the coronavirus, we're going to begin to see much better data out of oil and China and also the rest of the economy globally and domestically, and we're going to see things pick back up. But for right now, we're actually still not seeing a whole lot of our economic indicators triggering, and one of the most recent ones that we got that we received data on last week was the jobs report, and it came out super strong, which that's probably the most real-time report that we have on our economy, is how many jobs are being created or how many jobless claims are being asked for, and so or how many jobless claims are being made. And right now, we're not seeing an increase in jobless claims, which that's one of our indicators that we're following. So all of that is actually good news from an economic standpoint because it's telling us that so far, we're not at risk of a recession. Now, that doesn't mean we're not going to have a bear market in the stock market, which means we decline more than 20%. But it does mean that we are not in a recession, and that is important for us from an investment standpoint because when we're not in a recession, we recover much more quickly from these bear market drawdowns that are painful but short-lived. So how much worse could it get from here? I mentioned in my video on the 27th of February that we could experience at that point another 6 to 10% drop from where we were then. And back then we were at $291 a share on SPY. Today we closed at $277 a share. That's roughly a 19% drop. I realistically think that from 3 weeks ago to today, we probably could have going forward in the future, a full 22 to 25% potential drop from our high point. So that's another several points from where we are today. And I'm not saying that to scare anybody. I'm just saying that because that's realistically, if you go back and look at all of the major drops that we've had in 2011, in 2015, in 2016, in 2010, and you take out the actual recessions, you're going to see a 20 to 22% drop during those market environments. And they're not all that different from what we're experiencing today. Now, they may be different in how long it took us to get to that bottom, but the recovery time that they experienced was so much faster than the several year recovery that it takes us in a recession. And that is really important to how we invest moving forward, and how you should be investing moving forward, and how you should not necessarily be super concerned about where the market is today and where we will be, and I expect us to be in the next 4 to 6 months. So one other thing to remember is that until we get a solid foothold on the coronavirus, our economic reports will be disconnected from what's actually happening in the stock market every day. Just like we saw last week, jobs report came in super strong, but the market almost didn't care much about it. We had a down day still, and we will probably continue to see some of that play out until we begin a recovery of where we are with the coronavirus, and globally we get our hands around what's going on with that virus, which will likely happen, and hopefully will happen in the next couple of months as weather continues to warm up and we get further down the road with a vaccine of some kind. So for now though, we actually have been getting some decently positive reports, both domestically with jobs and globally with the services sector, but they just haven't provided any recovery yet. So what could turn the market around? I talked about this on the 27th. I'm going to talk about it again today because a few things have been updated. The biggest potential positive thing that could turn the market around is that we just get this virus under control. We either get it contained and we begin to see the active cases get reduced, and we can find that over here at worldometers.info/coronavirus. Today, right now, our total cases that we've had has been 114,231. We've had deaths of around 4,000, and recovered, this is an important number. The recovery number is actually bigger than half of our current total cases that we've experienced. That's good news. It means a lot of people are recovering and are getting close to being recovered. However, one of the things that is concerning to me, and why I say that we probably aren't through the worst of this downtrend, is that we're beginning to see a pickup in active cases. And that is largely due to the fact that we're just seeing an expansion of the growth rate in this graph down here. We're seeing an acceleration in the total number of cases that are being documented throughout the world. And that is also adding to the fact that we have active cases increasing. When we begin to see this chart come back into this trajectory and start to fall downwards in a meaningful way, we're going to see much better results from the stock market. But until then, this is the most important thing that can happen to help reestablish a bottom in the market and help us see returns again that are positive in the stock market, that are also sustainable. So that's one thing that can happen. Another thing, the Federal Reserve could lower rates again, and they probably will. But since that's not going to actually fix the virus problem, more stimulus from the Fed through lower interest rates and quantitative easing probably isn't going to have an immediate and sustained positive effect on the situation we're in right now with the stock market, but it will have very positive longer-term effects through mortgage rates and lending terms to businesses and consumers. And that's all really positive momentum, but it's going to take time to be realized. So, and the Federal Reserve actually said this too in their emergency press release when they lowered rates by 0.5% last week, is that this is a longer term play for them. They are getting ahead of the curve, and they're expecting that this is going to help filter through the economy over the next several months to years. And so I'm going to take a lead from them and actually tell you the same thing, that this is going to take some time for the interest rate environment and quantitative easing, if they provide any, to filter its way through the market and actually provide positive reinforcement to the stock market and earnings for our companies. And it will be helpful. We're just not going to see it right away. Another turning point, and this is the last thing I'm going to talk about turning points for the stock market, is that the government could put together a spending bill that helps offset the losses that some companies are going to face while dealing with the slowdown that we're going through right now. At the same time, though, similar to the Federal Reserve stimulus, this likely won't have an immediate lasting effect until we see numbers from the virus begin to improve and demand for oil, goods, and services increase again. And that is the most important thing that we can see. That's also, getting through this coronavirus is also the one thing that could help this oil war that just got started over the weekend to improve and for oil prices to reflate again. But oil is probably not at its bottom either. Most analysts are saying that we've got a little ways to go, potentially down to $20 a barrel. We're somewhere in the low 30s to close the market today. So we've still potentially got some room to go on the downside for oil as well. So what's the game plan from here, and how should we invest moving forward? We're not in an economic recession. Let me say it again. We are not in an economic recession, so stay invested. You cannot change your investor type from aggressive to conservative in the middle of a downturn, since they usually only last a few months, and because we're not in a recession, you're just going to miss out on the opportunity to recover from where we are today and the losses that you've sustained. You only when you sell in the middle of an environment like this, or become more conservative in an environment like this, you are going to prolong and sustain your losses for much longer than you needed to, even though it's painful, and I understand that. So we're going to give you some ideas a little bit later today, here in just a minute, to help you through that. Continue to stay away from international funds and emerging markets. They simply don't have the recovery potential, in my opinion, that domestic stocks have here in the United States. And they haven't for the last 2 years. I'm going to actually show you a couple of charts. Here's a one-year comparison of the NASDAQ 100 to the developed international markets. That's the pink line. And the orange line is emerging markets. They're both down in negative territory for the last 1 year compared to the NASDAQ, even after this big drop that we've had. Next, if we go to a 2-year comparison, they're down double digits. The developed international is down almost 13%, and emerging markets are down almost 18%. And I just don't see them realizing as quick of a recovery as what domestic stocks are going to realize and should realize as we get our hands around this coronavirus. So stay away from international emerging markets if you can, and if you have control over your investment situation. Next, rebalance your portfolios for your 401ks and your IRA accounts that don't have more advanced strategies available to them. You got to sell bonds and buy more stocks. Buy the market while it's on sale. That is one of the most important things you can do, if that's the only thing that you can do. One thing I did mention a couple of weeks ago as an idea to help you with the downside protection from where we were then is to buy puts. Right now, it doesn't make any sense to buy puts on the market. They're just far too expensive. You're going to spend about 5% of your account value that you're trying to protect. So let's say you want to protect $100,000 of your account with a put contract on the S&P 500. You're going to spend about $5,000 in order to protect your $100,000 investment in the S&P 500 for 1 month. And that's really, really expensive. We spent less than a quarter of that when we were earlier on in February and we put our put on. And so you've got to stay away from puts. Unfortunately, they're just too expensive right now with volatility being as high as it is. So if you have cash, another idea is put it to work. Now's a good time to be buying the market. Again, it's on sale. The way we did this is that we bought call options on the S&P 500 when SPY was at $296 a share. And those call options go all the way out to June 30th. So we have between now and June 30th for the market to recover back beyond 296. As long as the market gets close to where we even started the year, we're actually going to make money on that option between now and June. And I do fully expect that we're going to realize a positive return on that investment by the time we get there, because we'll have time to get through what's going on with the coronavirus and begin to see corporate earnings stabilize, which that will be positive for the market. And lastly, if you're a client of ours and you don't have options privileges set up on your account yet, reach out to us and ask for more information, and let's get those put together just so we can take advantage of some of the opportunities that are in front of us, because they're really, really positive opportunities. And it's a great way for us to recover faster than we would otherwise without them. The last thing I'm going to share with you, and this is what I promised at the beginning of the video, is What are some of the other things that you can use that aren't necessarily available in the marketplace without an advisor like us? One of the things is to use a hedging strategy that we like to build inside a market-linked note. And so the options market, because it's super expensive right now, and buying put options for protection is really expensive, buying call options is kind of expensive too, we can instead go work with large banks like Bank of America, Credit Suisse, Bank of the West, BNP Paribas, all kinds of other banks out there that actually package up options contracts in what's called market-linked notes in order to give us a defined outcome that we're looking for. And there's literally hundreds of different types of strategies that you can use, but there's three that I really like best, and I'm going to share one of them with you today. The first hedging strategy that I really like the most, and this is one we're actually putting into effect tomorrow for a lot of client accounts, is a 20% downside buffer from where we are today with 120% upside participation. So I'm going to show you what that looks like visually, and then I'm going to talk you through the numbers here in just a second. The blue line here represents the market return or potential future market return over the next 3 years. So we could have all the way down to a 30% loss over the next 3 years and all the way up to a 30% gain. Now this is all hypothetical. It could be a far larger gain than that. It could be a far bigger loss than where we are today if we entered a recession. But this is just giving you an example of what this vehicle is designed to do. So if we're in a downside situation in the market in 3 years from now when this contract comes due, we get 20% of a buffer to the downside. So that means that if the market goes down by 20%, we actually don't lose any money. But if it goes down 30%, your account or what the money invested into this strategy is only going to be down 10%, which you can see by where that red line ends. So that's pretty positive. If the market goes down 30% from where we are and we only lose 10 and we get to buy the market with only having lost 10, but the market's down 30, I'll take that trade-off most any day. But I don't think we're going to be down in 3 years from where we are today. Instead, what we get on the upside is we get 120% participation on the upside. So for every 20% return we get from the stock market, we could be up 24% in our actual accounts. So from where we are today to 3 years down the road, we're actually going to be better off than where the indexes are over that same time frame. So we get downside protection for 20% and we get upside multiplication if the market's positive over that time frame, which is a great trade-off as well. So here's the numbers. If we go through and we look at each of the probably most likely scenarios. One, we could have the index perform negative but within our buffer. So if we're down anywhere from 10 to 20%, our buffer is on the first 20% of market performance or losses, and our return would end up being 0 over that time frame. So if the market ends negative within that 20% buffer, we don't lose any money. If the index performance is negative and goes beyond or exceeds that buffer, our investment loss is reduced by the amount of our buffer. So if we're down 20 or 30%, then we get a 1-for-1 loss beyond the buffer. So at a 20% loss, just like up here, we don't lose any money. At a 30% loss, we're only down 10. At a 40% loss, we're only down 20. I shouldn't say only. Being down 20 is a pretty decent number, but if the market's down 40, we're going to be in a lot better shape to recover quickly. And finally, if index performance is positive, your investment receives a 1.2% price improvement that is uncapped. It could be up to 60 or 100% return over the next 3 years if we have really great returns in the stock market. And so if we do get those, we get a 20% multiplier on top of whatever the index performs. So if the market's up 10, we get 12. If the market's up 30, we get 36. And that's kind of how it works. So this is a really great place to help us right now by not getting too conservative, but still taking some of the risk off the table. So like I mentioned earlier in the video, you cannot get more conservative when the market's down. You just hurt your loss, or you hurt your growth potential and your recovery time. This is one way to limit how much more downside we can experience in your account or downside you could experience in your investments, but still not give away the upside potential that we all want and we all need for our investments to produce for us. So this gives us the best of both worlds, 20% downside protection from where we are today, and 120% on the upside from where we are in the future. So I really like really like that option. If you'd like to know more information, this is just one of the strategies that I like and that works really well in our current market environment because we've lost so much from where we were just 3 weeks ago. And so our recovery potential between now and 2 or 3 years from now could be incredibly substantial because we've got a lot of really fast upside opportunity in the market, just like we did in January of 2019, right after the big crash in 2018. We saw over a 20 or 30% return in the market from the day after Christmas to the end of the first quarter. So this has a huge opportunity to help us out and grow our money quicker. There's 2 others strategies that I like just as much, but I don't have time to talk about right now. We're already too long in the video today. So if you'd like to learn more about those 2 strategies, you can either message me on Facebook or send me an email at marketnotes@epictrust.com. And I really want you to use this email, not my personal email, because this will let me know and let my team know that you're wanting more information specifically about this strategy or the other 2 strategies that I can share with you, or that somebody on our investment team can share with you as well. So if you'd like to learn more, message me on Facebook or email me at marketnotes@epictrust.com, and we'll see you soon. Thank you guys for watching. Remember, just a quick heads up, investment involves risk, as we've seen over the last several weeks. There are no guarantees, but we can be smart about where we're going from here. So we're here to help you. We want to help you. I hope you have a great day. Hang in there. Don't give up yet. This is temporary. It's not going to last forever. And I believe in you guys, and keep doing the things that are making you successful over the last 20 years, because the next 20 years are just as bright for our country and for you and for us. And we really look forward to working with you. Thanks a lot. We'll see you. Bye.